On-site coverage of Resourcing Tomorrow is brought to you by Rio 2.
Ronnie, good to see you again.
Good to see you, Peter.
We caught up, 3 weeks ago in Zurich for the Precious Metals Summit. We had a lot of a focus at that point on gold, and obviously we had the pullback, and we were sort of evaluating or sort of trying to understand your theory on whether or not we'll be seeing another leg higher or if we're sort of sideways trading. I think from memory, correct me if I'm wrong, you were sort of anticipating sort of what's going on now, sort of sideways trade, maybe a little bit up, but really the big kick will be next year. Was you anticipating that silver would be going on a rally before the new year?
No, I think, the momentum and, the strength of the market in gold, but also in silver is just really impressive. When we talked in the Precious Metals Summit in Zurich, I said that we're now like 35% cash in my fund. Yeah, so we were pretty happy about the correction. We picked up some really good companies at very decent valuations. So that was really good for the fund. We had this year the max drawdown, I think, was like 9%. Yeah, which is already telling you this enormous strength in the mining space. Yeah. And now. My take has always been, and this is the main thesis of this year's report, the big long, that gold always goes first, and then at some point, like at a cycling race, at some point there's out of the windshield, there's actually silver, the mining stocks really with huge momentum breaking out, and this has happened. Silver has made new all-time highs, but still, on absolute terms, we're basically at the same levels like in 2011 and 1980. Inflation adjusted, it's still dirt cheap. And not only on an absolute level, it's inexpensive, but on a relative basis compared to gold, silver is still a bargain. So I think that's going to be a great 2026 for silver. And I think now with this enormous amount of momentum behind this move, I think we can go to triple digits next year.
Yeah, is that what we're okay? So it sounds like you've answered my next question, but it's so you are seeing this now as that next leg where silver does start overtaking gold.
Yes.
Yeah.
Yes.
Okay. Wow.
So in every big gold bull market, as I've said, gold goes first, and at some point silver picks up momentum. And I always said that what's really missing for silver is investor demand. If you have a look at the volumes traded in the silver space, silver mining space now. If you have a look at the flows into the SIL and also some silver ETFs, then you can see that investors are finally waking up and say, okay, well, relative to gold, silver is cheap. It's now a critical mineral for the United States. It's a green metal, whatever that means. Yeah. So I think now finally investors' demand is coming in. And we know that the silver market is tiny, so it doesn't need like a lot of capital to really move the needle.
How much of this are you seeing as investment demand versus, because obviously we have had this supply shortfall for 5 coming on to 6 years now in terms of a deficit. Is there finally some of that sort of catching up into this, or is this really more inflation adjusted for what the price should be, more investment demand from the West that we're seeing at the moment?
Yeah, well, I mean the physical demand coming from the industry, photovoltaics demand is up like 180% in the last 5 years, I think.
Yeah.
That's pretty, that's basically a given. Yeah, that's also easy to calculate and to model. But what's harder is obviously investment demand, and that's based on the momentum that we're seeing in the space, that the momentum also of risk appetite, based on a number of other drivers, inflation, obviously, silver usually does really well in inflationary times, with Mr. Hassett now probably being the next chair of the Federal Reserve, we can be pretty sure that we'll see significantly lower rates. I think inflation will make a comeback next year, so we'll have a stagflationary environment next year. Not sure who Donald Trump will blame for that, but he'll come up with a
scapegoat.
With the scapegoat.
Yeah.
So I think that's a really good setup for silver. And I always said, when people ask me, where is the future demand for gold coming from? I say, well, we're seeing a huge reallocation of capital. We're in the fixed income space, there's like 170 trillion allocated. So if this is like the big pie, the big cake, yeah, if there's even some small crumbs moving into gold and silver, that really makes a difference. And you know, with solvency risks and with of course the demographic issues that we have, yeah, with basically just in the first half of this year, 21 trillion of new debt, and I think the second half of this year will probably be even worse. So if you put it into context, that's basically the market cap of gold at the moment. Yeah, this is just new debt added to the market in just 6 months. Yeah. Then I think there's a pretty strong case for more money coming from the fixed income space into hard assets. And, you know, we came out with this new 60/40 portfolio last year, and there's now companies even larger than Incrementum, like Morgan Stanley, for example, saying, you know, the 60/20/20 portfolio with 20% gold. We're seeing now that, you know, Jamie Dimon, who hates gold, yeah, he's coming out saying that he can see gold trading at 5,000 to 10,000. So I think, you know, we've seen quite a lot of changes this year, and I think that the real story behind, you know, the story that gold is in a bull market and everything, but the real story behind is institutional players finally reallocating capital out of fixed income and into hard assets.
In the heart of Chile's Atacama Desert lies one of the largest gold oxide deposits on Earth, weighing in at an impressive 4.8 million ounces in measured and indicated resources. This is the largest, permitted, fully funded gold heap leach project in the Americas. Rio 2 Limited is bringing the Phoenix Gold Project into production. Construction is nearing completion, on time and on budget, with first gold pour scheduled for January 2026, just weeks away. Phase 1 starts with 20,000 tons per day, delivering approximately 100,000 gold ounces per year at an ultra-low, all-in sustaining cost of just $1,237 an ounce. In today's record gold market, that's thousands of dollars in cash margin on every ounce produced. Rio 2 will also undertake a pre-feasibility study for a potential Phase 2 expansion. This will assess the full potential of scaling the mine to 80,000 tons per day, with the view of producing at least 300,000 ounces annually for 10 years, starting in 2030, making this a near-term, massive free cash flow company with even bigger aspirations and margins in sight. From one of the safest, most mining-friendly countries in the world, delivered responsibly by a team that's done this before. Be a part of it. Visit rio2.com today.
I get the feeling now that the central banks are totally agnostic, or if anything, they're preferring a higher gold price, because in the West they've got collateral against their ever ballooning debts, and in the East, obviously they're using that as a hedge against dollars, right, and the de-dollarization and weaponization of the dollar. So it doesn't really appear to me as though any central bank around the world would have too much of an issue of gold continuing to decline. Because one, you can hedge your existing debt against it, which we're going to need to do in the West. And in the East, well, they're buying and buying more and more and more of it, and the value of what they're having is going up and up and up. Are you reading it the same sort of way?
I'm not 100% sure. I think, you know, what kickstarted that development, that central banks have now 3 years in a row bought them more than 1,000 tons of gold. And this year, probably it will be slightly less, like 850 to 900 tons of gold, but still significant. Yeah, that's a little bit less than a third of annual gold production. Yeah, so that's quite a lot. But I think what really kickstarted this is obviously that the war in Ukraine and the sanctions against Russia, and then many countries woke up and said, yeah, well, actually, we need to have a less counterparty risk in our portfolios. We have to have an asset that cannot be sanctioned, that cannot be taken away from us, yeah, like US Treasuries. So you need a neutral, non-inflatable monetary reserve asset that is highly liquid and basically accepted all over the globe. Yeah. and gold obviously is the obvious choice for that. And then I think that many central banks from emerging markets, they realized, well, actually, compared to industrialized nations, our allocation in gold is significantly lower. So there's some catch up happening. And then obviously there's this whole de-dollarization trend. My take is that the de-euroization happens first, and we're seeing now gold being the second largest reserve currency.
Yep.
So it overtook the euro. So how long will that continue? I think, as far as I know, central bank policies, there's once they've got a policy in place, they continue with that for quite a while. So I think it's going to continue. Poland just said that they want to have up to 30% of their reserves in gold. So I think they will buy, what was it, 180 tons for more tons of gold. We all know that China owns significantly more than they officially announce, and they probably buy more than they officially announce. So I think that trend will continue. But this emerging market demand has really been the pillar of our gold thesis over the last couple of years. Not only central bank demand from emerging markets, but also physical demand coming from consumers, from investors. So if you travel to Shanghai, to Mumbai, to Dubai, you will realize how important gold for them is. And you will also realize that, well, actually, the party isn't in Europe or in the US anymore, but let's say party in terms of, economic growth and, a positive outlook, but rather in emerging markets. And there's a very high correlation with disposable income and general positive sentiment and gold purchases in emerging markets. So this is kind of the love trade. Then we have emerging market demand from central banks, and now only very late at this stage, now there's Western financial investors coming in. JP Morgan just came out with a study basically saying that Western institutional players own 2.8% of their total allocation in gold.
Wow. Okay.
So I think there's still some room for more, because it doesn't really move the needle as a portfolio hedge.
We can't expect, even though we have heard other people, like you were saying, Morgan Stanley calling for 20%, we're not expecting the Western institutions to really get up to that number, though, are we? But I guess the whole point is, even if they get up to 4%, 5%, I guess that has a huge impact on potential gold price.
It depends on the price of gold,
Yeah.
I mean, if we're at 3% now, and the price of gold triples, then we're at 9%.
But are we at 3% because the price of gold has increased and they were actually at 1% 3 years ago?
Yeah.
And they haven't actually bought any more gold. Is that really why they're only 3% of it?
No, yeah. I mean, I see your point, and I think that most of the time when I talk to institutional clients and they say they have a gold allocation and want to talk about gold, they're considering selling gold actually.
Really?
Yes. Wow. Yes, because it had a big run and they want to take some profits, and I say, okay, but what you're gonna buy with that, with that money? And I think this is telling me that we're in a bull market, but not like in a bubble. I think that we still have like 2, 3, perhaps 4 really good years ahead in this bull market. We're not yet at the crazy stage of the bull market. So I think that gold is, perhaps it's slightly overbought, or it was overbought in October, obviously, but it's underowned. But then having a look at the mining space, finally outperforming gold now, having a look at silver, finally outperforming gold, and also at the commodity space in general, which is always a laggard, but now it seems to be picking up some momentum with nice moves in copper, but also in platinum and palladium. I think that now we're really, now this train has really, started to, leave the station. And I think one very important topic, and that makes me pretty convinced going forward, is the fact that, if you attended like mainstream conferences over the last couple of years, there was like one big topic, and then there was ESG. So everybody wanted to act and invest on a very sustainable way and very green way, whatever that means.
Yeah, I remember those days. Yeah.
And I once said, I think I'm at the wrong conference because this looks like a Greenpeace convention here. So and this has changed, but during that stage, obviously, everything that was, in the commodities space, everything that had to do with precious metals, with oil, with natural gas, with basic resources, was basically just sold off, and asset allocators just wanted to get rid of that, So they're massively under-owned now, or under-allocated in the commodity space now. Then we've got, from a technical point of view, we've got really, lots of relative strength, nice breakouts on the charts. From a fundamental point of view, lots of companies are making tremendous amounts of free cash flow, returning cash to their shareholders, buying back shares. So it's a really good combination of strong fundamentals, technicals, and the mainstream world that is largely under allocated in that space.
When we spoke at Beaver Creek, I remember we were talking about the different phases of your model, where you were going aggressive and defensive, etc. But I remember one of the things that really stood out to me was when you're at a party and everyone's talking about how they're loading up on silver juniors and it's full leverage. You were saying that we're then sort of looking at a peak. Do we feel like we're nearing, because obviously there is a bit of a mania at the moment with silver, just because we have now broken that all-time high. But at what point does it change from, okay, we're excited because it's broken out of an all-time high, to, okay, we're in a mania phase and we need to actually watch ourselves? And
good question. I mean, I think we in the mining community, we're super excited about silver and financings for new hot silver juniors, but we have to be realistic. The mining community is like tiny compared to the rest of the investment community. So what I see, and we talked about that already, is mainstream investors are slowly but surely waking up when it comes to silver. When it comes to mining stocks in general, I don't really see too many generalists coming in, to be honest. Some hedge funds are coming in. They're always a little bit earlier than like the mainstream generalist funds. But I think, I don't see like big excitement in the junior silver space coming in from people that have never invested in mining stocks yet. It will happen at some point.
So it's not too early to be accumulating silver stocks potentially then? If I was sitting here and I wanted
quality names,
quality names, still enough time to get in.
If there are some quality names in the silver space, yes, definitely. But we once wanted to launch a silver mining fund, and then we realized that the investment universe for real silver
pure silver companies
is actually very small.
Very small.
Which makes it easier for me as a fund manager, but then,
Well, there must be, I'm sure there's ETFs where are there any ETFs that just follow pure silver plays? Oh, there are. Okay, Maybe that's the way. Yeah. What's moving in? Obviously, we've got the typical sort of Christmas shutdown with most of the funds now sort of winding down, or at least looking forward to doing that. I can't imagine there's going to be loads of tax loss selling, which we have seen in years gone by in the junior space. So usually what we see is, obviously December comes around, the close are all closing down, everyone's doing tax loss selling. A lot of stocks go on sort of sale almost around Christmas. I don't know. I'm assuming that, like me, you're not really anticipating that to be the case too much, because most stocks are up in the mining space. So what does that mean for sort of the strategy going into January, February, March? How are you guys playing the market looking into the new year?
Well, you really have to be a superstar to produce like losses in this space. Yeah. So I don't know. I don't expect too much of a tax loss selling season. But we're seeing that, we're doing some reallocations in our fund. We try to pick up some quality names at lower prices. We put in some stink bits, so perhaps there's like liquidity drying up over the next couple of weeks, which it usually does. The funds basically say, okay, let's call it a day. and enjoy the Christmas break. So we try to use that kind of a dry season to load up on names that we like.
Nice.
But then on the other hand, we can see that with all the financings that have come out lately, there's just an enormous amount of demand coming in. It's still, you know, if you compare it to the rest of the market, it's still not huge amounts of capital, but you can see that risk appetite finally is back. So yeah, that's basically how we play it. Yeah, we're reshuffling within the portfolio. Also, I've had like, oh, it's like 200 company meetings this year.
Wow.
There's some good names that we don't own yet that we want to own, yeah, but at reasonable prices. So that's basically what we're doing now.
And this time next year, where do you think we are? Silver price, gold price? Can I push? It's one of them where if you say a date, you should never give a price, right? But just in general, though, obviously you did mention triple-digit silver. Are we a year away from that, do you think, or are we a few years away from that?
I think it can happen pretty quickly, actually. Yeah, it can happen within the next 6 months. Yeah,
Wow.
that silver goes to 100. I mean, we shouldn't be naive and say, you know, if the general market environment stays positive, yeah, if there's no like external big event like GFC thing, yeah. If that's not happening, of course, we've got midterm elections next year, so Donald Trump will probably try to keep the markets up, yeah, and keep, you know, the economy up. So if everything is going well, then we can see triple-digit silver next year, and I think gold pretty easily above 5,000. So our long-term target for the inflationary scenario is 8,900 by the end of this decade, which sounds like a big number, but that's a CAGR of 16.3% from now until 2030. I think that's pretty realistic.
Well, given what's happened over the last 2-3 years,
Yes.
I think that's more than realistic, isn't it, if it carries on? Yeah. No, Ronnie, thank you so much for your time.
Thank you, Peter.